Earlier this morning, an op-ed penned by President Biden was published by the Wall Street Journal outlining a three-part plan to combat high inflation. Part one of the plan acknowledges that the Federal Reserve, quote, has a primary responsibility to control inflation. Part two involves making goods more affordable for families and focus on high gas prices. Part three of the calls for reducing the federal deficit through, quote, reforms to the tax code and end the outrageous unfairness in the tax code that allows a billionaire to pay lower rates than a teacher or a firefighter. Right, joining us now to discuss is former CFTC Commissioner and an advisor to Andreessen Horowitz, Crypto.com, and board member of Predictions Market Kashi. Hello there, Brian. Thanks for joining us. So, President Biden wants to make combating inflation his number one priority. Does this meeting indicate he needs Powell in that fight?
Well, absolutely. I mean, I think if you look at the public polling around it, I think it has become the most important issue to a majority of voters out there. And while the central bank certainly has a role and has needed to play a role in fighting inflation for a while now, the government still has a role as well, which is to control spending. And I think if you really look back, first of all, you had mentioned the president's op-ed in the Wall Street Journal. I was very encouraged to see his first point in that plan to respect the Fed's independence and to acknowledge that they had the highest priority in their job description and their authority to combat inflation. I think that is a very important thing to have on the record. I think the meeting between the president and Chairman Powell just ended. The readout that I saw was that Brian Deese, the head of the National Economic Council, said that the meeting was constructive and focused on the future for the U.S. economy and the global economy. So, not a lot of specifics, but I actually also take that as a positive, that there isn't a public effort to badger or to try to push the Fed in a certain direction, and to acknowledge that everyone has a role to play in combating this problem.
Well, I suppose if there weren't many specifics, but what would that mean? Will that mean the Federal Reserve should be more aggressive in rate hikes? And, in the upcoming meetings, could they become more aggressive or less so because, they don't want that impact on equities and business in the markets?
Yeah, I think you have to acknowledge where we're starting from right now, from the Fed's balance sheet and the amount of spending that has occurred and the amount of money that's in circulation. Money supply, U.S. money supply, has increased by 40% over the last 2 years. The Fed's balance sheet rose 75% in 12 months, from March of 2020 through March of 2021. To a record $7.6 trillion, and now stands at $9 trillion. And it was on that $7 trillion level that the American Rescue Plan that cost $2 trillion was passed. So we have a lot of money kind of sloshing around in the system through both Fed easing and government spending. And so there's going to need to be an aggressive approach, I think, especially when we see inflation at 8% and the price of oil at close to record highs, I think over $115 a barrel. And the market's already pricing that in. The last I had seen, I think, the Fed was talking about 50 basis point hikes for at least the next few meetings. I think the market's pricing in closer to 75 basis points. And so, the market's already expecting that. The market's already thinking that the Fed's going to need to move more aggressively than it has. And I think you're showing the Fed's reverse repo facility graph, which is another example of how much money is in the system. That's kind of where banks park excess liquidity. And as you can see, between 2014 and 2018, the average was about $100 billion, where the banks go and they purchase a security from the Fed and then resell it to the Fed the next day, for a slight bit of profit. It's just basically a way of earning interest on excess liquidity. And that basically tapered down to almost zero usage between 2018 and 2020, early 2021. And then it's just exploded to over $2 trillion, kind of right as the American Rescue Plan was signed into law.
What do you think this all means for Bitcoin in the end?
Well, I think it's positive for assets that aren't necessarily tied to the value of the dollar, and I think that for assets that have limited supply and crypto in general, I think there's been some characterizations or short-term thinking around looking at prices and saying, well, if inflation's gone up so much, why haven't we seen the price of crypto go up as much as well? But I think over the long term, you have seen that used as an inflationary hedge. I think you just have to take a step back and look a little bit longer term. And the other thing, though, is that we're just in an extraordinary market condition right now. We have the chance for the stock market and the bond market to both be going down at the same time, given that the goal of QE, when it was originally created, back in response to the financial crisis, was to actually inflate asset bubbles. And so we had an inflationary bond market. We had, from a pricing perspective, we had the stock market be inflated as well. And now, when we would expect to see, differences in correlation and one act as a hedge, we could see them both be going down at the same time. So I wouldn't take any short-term views off of correlations in this market on anything.
Fair enough. As an advisor for A16Z and Crypto.com, I wonder, what is the strategy during a bear market?
I think it's the strategy that it always is, which is to continue focus on building, continue to focus on founders, continue to focus on growing customers and providing good products. And A16Z Crypto released a phenomenal report 2 weeks ago. It's called The State of Crypto. And there's a wonderful slide in that deck that shows the continued increase in developer activity that we are seeing, over the last 4 or 5 years, and it is continuing to go up and to the right, so to speak, in graph terms, and it's uncorrelated completely with price, and so we're just seeing more and more interest, more and more expertise. The world's and America's best innovators, technologists, entrepreneurs be attracted to this space, be attracted to founding companies in this space, projects and protocols and building and creating communities. And so, I think it's a really interesting time, and the enthusiasm that we're seeing for that has not.
What's interesting about that report is it mentions, in bear markets, the teams in crypto, they tend to hunker down and they continue to build, and, projects that may not have been made to last, they end up getting lost when the bull rally ends. Speaking of which, as we saw the fallout of Luna earlier this month, and as a CFTC Commissioner, I wonder, what are your thoughts around, crypto projects like that? How should they be regulated? Already we're seeing Luna version 2 out, and at least this morning it was rising 50%. Other days it's been quite much on the downside, very volatile.
So the thing I'm attracted to about crypto and blockchain and tokenization generally is the transparency and the open source of the programming, so that people can know what they're getting into. And I think if you look back on the Luna Terra situation, there were plenty of people that had seen some of the challenges that could happen and predicted some of the potential downside risk that ended up coming to fruition. And so, I think I personally separate those kinds of projects from more centralized, custodied stablecoins because of the difference in asymmetric information. If there is a central point of control over the algorithm that's trying to perform a function of keeping a token stable in value, or central control over the assets that are backing the stablecoin, I think fundamentally that's historically been a place where regulation tries to solve some problems of asymmetric information and differences in incentives. But when you have a really pure, algorithmic stablecoin like DAI, from MakerDAO, that has been in existence for a long period of time and is over collateralized and is well used, I don't even know. First of all, I don't know under what premise the regulators or policymakers would justify regulation of it, given its use and success. And second, I don't even know how they would go about doing that. So I think the takeaway from me in this whole conversation is that all of a sudden everyone's trying to figure out in Washington what an algorithmic stablecoin is, and hopefully, I think they'll start doing some research into the fact that it's not one thing, that it's multiple things, that it can be over collateralized or under collateralized or non collateralized.